This week, Ben and I are going to talk about some trade friction with Colombia, along with some macroeconomic pressures, looking at the Federal Reserve and some other areas as well. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
Doing great. Big Chiefs win last night, Will, and so
Yep.
I'm feeling pretty good.
Yeah, well, Ben is maybe the only Bills fan in Missouri. It stung just a little bit on my end, but it's all right. There's
You're not the
always
only
next year to lose in the AFC conference title game. So,
you're not the only Bills fan in Missouri. My neighbors just down the road, not too far, are Bills fans. They had their sign out in their yard yesterday, so I noticed it wasn't there tonight though.
yeah, yeah. Well, it is what it is. But anyway, talking about is what it is, we actually saw some gains in the market, although somewhat slight. Giving a quick rundown here, looking at that corn futures contract for March, up 2 cents at 486. December up 5 cents at 461. March soybeans up 21 cents at 1055. The deferred contract in November for soybeans up 21 cents at 1048. Soybean oil on a cents per pound basis for March down 0.47 cents at 45.22. Soybean meal by the short ton up $8.70 at 305.90. March wheat up 6 cents at 544. March cotton was about flat at 67.61. And then that West Texas Intermediate crude oil contract down $1.86 a barrel at 74.66. So, Ben, a lot of light gains on the week, but we did have a little bit of volatility to close out last week. What's your take coming into this new week here as we keep progressing forward in the market?
Sure. So it was really driven by the soybean market. Saw some strength in that soybean market last week that was driven partially due to a delay in any type of tariff announcements. I think that helped. I think the market move a little bit higher with the possibility of working out a deal before imposing tariffs. So I think that helped the soybean market. Also, the forecast was still looking very dry for South America, and especially later planted soybeans that still have some growth to them. Was looking very dry at the end of last week. Here, the start of the week, we've given some of that back. I think again, it's kind of a reverse of everything I just said. Some beneficial rains, widespread rains across South America, and then frankly, unfortunately, or however you want to look at it, some more tariff news that I think refocused the market's attention back to, hey, this could happen pretty quickly. It could happen without a whole lot of announcement. And so I think that refocused some of the market back towards thinking about tariffs in the next week or so.
Well, Ben, it's kind of been what seems like a fast week of a lot of action with the new administration taking over. We've kind of returned back to maybe some would remember some no, I guess heavy-handed trade policies or more aggressive trade policies when talking about negotiation. So we've already seen some pushback between the U.S. and Colombia on some trade negotiation between Trump and Colombia's president, which ultimately there was an avoidance there of, too much lasting items there. And, as Ben, you've talked about in some of your reports, Colombia is a notable corn buyer of the U.S. So just looking at that relationship there, what does not, I guess, imposing tariffs there in that area really mean for the U.S. corn market specifically?
Yeah, so it's not just the physical product of corn grain, but also ethanol. Ethanol trade with Colombia is a growing industry, and we've seen some recent kind of movement, I think, on that front the last couple of years with the Colombia government willing to buy U.S. based ethanol products, and so we've seen some, I guess, more market penetration within the Colombian market for U.S. products, specifically corn and ethanol, and a range of other commodities as too. But and so basically, I think as this materialized over a period of a couple hours, things kind of got straightened out in the end. And today, yeah, we're seeing a little bit of sellout on Monday of this week, but it still, I think it changed. It reminded the market just how quickly this can move. And I certainly think that with Colombia being as close as what they are to the United States, they're a nice market that we want to continue to maintain in some capacity. We want fair trade, but We certainly don't want them looking to Brazil, I guess, as a potential source, because that would be geographically friendly as well. So maintaining that market, make sure that they're playing fair, but certainly maintaining the market would be something that's I think beneficial to the corn and ethanol markets specifically.
Well, and talking about how quickly things can change, there is, some pressure looking at trade partners like the Canada and Mexico, obviously huge agricultural trade partners. With Trump potentially, looking at putting tariffs on these trading partners as early as the first week of February here in a few days. And, we've gotten several people sounding off on what this could mean for agriculture, congressional leaders like Chuck Grassley, and then reps from NCBA and others, talking about some fears that this could impose into the ag sector. So, Ben, as you look at the potential for this policy, how do you expect the market to respond as we move through these periods on even just the threat of tariffs, not necessarily the actual action itself?
Well, Mexico is a major market. I think a lot of people have kind of become aware, if they didn't already know, just how important Mexico is as a
Mhm.
trading partner to the United States, both in terms of the types of products we trade, but then also just the sheer geographical location. They're right to our southern border, and so they make it easy and feasible for us to move products to them, and they've like I said, they've bought a lot of products. I think for me, I'm going to go back to the corn market here for just a second. It does concern me how much corn they have purchased that remains unshipped. Substantial amounts of corn that have not been shipped that remain committed. And in prior years, we may have talked about China canceling some sales, putting some sales on the books, and getting the market excited, and then canceling those sales. This is an area where, frankly, I do worry maybe a little bit that if this does go into place this coming Saturday, and we see kind of an escalation, do we see Mexican buyers cancel some of those U.S. corn shipments? I think that is a concern. With everything, we'll have to see what happens. It's not a done deal by any means, but certainly that is an area where I think there's some risk for U.S. corn producers.
Well, and talked about, that the corn market specifically, Ben, you've talked about the long positions in the market that we've seen. We've seen an 80-cent increase on that corn contract coming from October to where we are now. So, seeing some of those tensions, do you expect that to maybe shift some of the momentum in the corn market from that steady build that we've seen over the last, 4 months into where we could be going here short term?
Yeah, it wasn't that long ago. Just a few months ago, we were talking about an all-time record net short for fund managers in the commodity space, or especially in the corn market. We had large net short positions, and so one of the things that was hanging out there was that if the fundamentals started to build, we could see money managers start buying back into those positions, or even frankly just taking a neutral position heading into the election season. I think was a possibility, or at least a thought for many money managers. You're right. We have built a rather large. It's not record large, but rather large net long in the corn market, and when we look at it, it's the longest such position since May of 2022. I think money managers have recognized the bullish fundamentals in the corn market. However, I would simply say that a lot of times we see the market peak when fund managers are, at the peak of longs, and it's kind of a chicken or egg game. It's not necessarily one comes before the other. It's just that they represent sentiment of the market, and so I really do think that if we do see the market start to consolidate lower or condense lower due to concerns that we've already outlined, and anything else that could potentially come up, I would expect some selling by fund managers, which is going to cause the market to move a little bit lower, even still, right? It can further consolidation. So that's another thing, another risk that I think's hanging out there for corn producers. I don't know if we meant to have this episode be all about corn, and risk to corn, but that would be another risk out there to corn markets, is this very large, relatively large net long in the corn market or futures market, that if it were to start correcting or even moving more towards a neutral position, we'd see some pressure on the markets.
Yeah, so basically, there is a decent amount of risk there within the core market for that to move lower. But Ben, turning the conversation a little bit more broadly, we've been seeing some tension applied to the Fed and interest rates as well. President Trump has, been vocal about wanting to lower slash those interest rates, but really cuts aren't necessarily expected too soon. So what's that balance right now, and how is that really impacting the overall general economy, which of course, trickles into agriculture?
Well, I don't think it's a secret, really. I personally, I think Jerome Powell's got a tough position as chairman of the Federal Reserve. Any politician, it doesn't matter which political party, politicians love to see lower interest rates. There's a whole host of reasons for lower interest rates. And frankly, we as consumers like lower interest rates. If you're consuming product, if you have a bunch of money and you're looking for investments, you might want to see higher interest rates that has a higher impact on maybe some savings and different things like that. But there's a lot of reasons politicians desire lower interest rates. And so the president has certainly put some pressure on his Fed chair. He nominated and appointed Jerome Powell to be the chairman. He'll have an opportunity to either reappoint Chairman Powell or find somebody else here in the next cycle when it comes up for renewal. But I do think there is a tough position, frankly, because we've seen the last couple of months prices heat back up. The job market seems to be relatively strong. The only indication where we saw some softening in the economy actually came this week. The Consumer Sentiment Index, which is ran by the University of Michigan, released every month, gauges consumers' confidence basically in the economy. It's not perfect. No survey is perfect, but it provides what consumers are thinking. And it showed softening for the first time in 6 months. A double whammy too. It showed that consumers are concerned about higher prices and increasing prices, and it also showed them concern about expected increases in unemployment rates. And so both of those are things the Fed doesn't want to see. They want to see employment relatively stable, and they want to see prices relatively stable. And so moving in the wrong direction, at least from a consumer sentiment piece, and frankly, moving in opposite directions. Increasing or lowering increasing rates impacts both of those differently. So, interesting dynamic here, and it'll certainly be interesting to see not only what the Fed does this week, but the minutes of their meeting this month, because I really, really do think that they're in an interesting position where the signals are maybe signaling for an interest rate stabilization to even possible hike, and there's a lot of pressure on them to cut rates.
Well, Ben, going back to the sentiment report, it's another one of those things where they're kind of two different spokes in the same wheel. Is sentiment driving the market, or is the market driving sentiment? But as we look forward to the rest of this week, what should farmers and ranchers really be paying attention to that could change that sentiment and move the markets?
Yeah, so it is kind of a rather busy week in a lot of ways. A lot of different things that we could watch. That Federal Reserve Open Market Committee interest rate decision will come out Wednesday afternoon. It's probably more the language at the press conference afterwards that'll drive the market, whether it's seen as friendly and moves the market higher, or the market's disappointed and we see sell-offs in the broader equities. We get other economic data this week. The personal income and spending report comes out on Friday. That's always an interesting one, just from my standpoint, because I continue to wonder and monitor how people are spending money, and it's certainly at the rates they are. And then next Monday is the first working day of the month, and so we get all the grain demand reports, whether that be oils and the grain crushings report, the flour milling, the cotton systems. Those all come out next Monday. So kind of a busy week and a kind of a random assortment, or an unusual collection of reports, I guess, for us.
Ben, real quick, one of the things that kind of makes me chuckle is watching people, jump in the market based on sometimes what Jerome Powell's first words are on some of those press conferences, whether it's hello or good afternoon or whatever it is. And they're like, oh, there you go. There's the sentiment. But anyway, viewers and listeners, if you'd like to learn more about us and what we do, check us out at brownfieldagnews.com. Ben, I appreciate having your knowledge and information here on the program. And I'm Will Robinson for Brownfield.